Welcome to LR Reports. LR Reports delivers concise, research-based briefings drawn from leading global financial institutions and independent research firms. Each episode focuses on the core investment thesis, key assumptions, and material risks outlined in the original research. This program is designed for listeners with a working knowledge of financial markets.
Welcome to the Deep Dive. Today, we're taking a scalpel to what is probably the most anticipated piece of institutional research defining the year ahead. We're doing a deep dive into the January 6, 2026 Goldman Sachs Global Investment Research Report titled 2026 U.S. Equity Outlook, Great Potential.
This is really the roadmap everyone's been waiting for.
It is. It frames how major money managers are thinking about this transition into 2026.
And, the report sets a very ambitious yet fundamentally driven target for the year. The core thesis is straightforward.
Which is?
We're looking at another solid year for U.S. equities driven almost entirely by corporate profitability. Goldman Sachs is forecasting an S&P 500 total return of 12%.
12%.
Which gets the index to a year-end level of 7,600.
Wow. A 12% return is a significant target, especially after the strong gains we saw in 2025. What's the actual bedrock supporting that optimism?
It really boils down to earnings, pure and simple. They're projecting S&P 500 earnings per share, or EPS, growth of 12% in 2026.
Yep.
And that's followed by a robust 10% in 2027. This profit strength, really, combined with healthy underlying economic growth, is the fundamental reason they believe this bull market can continue.
Without relying on, say, multiples just getting bigger and bigger.
Exactly, without relying heavily on multiple expansions.
Okay, so let's unpack this. Our goal for you today is to analyze that macro foundation supporting the aggressive 7,600 target, but then immediately pivot to confront the major tensions.
Right.
We have to focus on the twin risks of, historically high valuations and the necessary but potentially painful evolution of the AI trade.
We need to see if the structure of this market can actually handle the pressure.
Let's start with the macro environment then, because these friendly macroeconomic forces are often what allow PE multiples to rise in the first place. What specific backdrop is this outlook built on?
Well, the environment is decidedly friendly. And critically, it contrasts sharply with past market peaks where, the Fed was tightening and growth was stalling.
Right.
Goldman Sachs economists are expecting above consensus U.S. GDP growth. They're forecasting 2.5% on a Q4 over Q4 basis.
That's a strong figure, but the question is always, where are we in the cycle? Is this the last gasp of expansion?
No, and that's the key point. The report defines this as a mid-cycle acceleration, not a late-cycle peak.
A mid-cycle acceleration, what's driving that?
This momentum is attributed to a few specific factors. First, you have favorable momentum from easing financial conditions. Second, the labor market is stabilizing. And perhaps most importantly, there are tailwinds from the significant fiscal impulse provided by that major 2025 OBBA fiscal package.
That OBBA fiscal package is a really important input here. So for the listener, we're talking about massive legislation passed last year, a mix of corporate investment incentives and tax adjustments.
That's right.
Is that stimulus mostly driving corporate profits, or are we seeing a push into consumer spending too?
It's actually acting on both sides, which is why it's so critical. The investment incentives support the CapEx necessary for AI adoption, which we'll definitely get to later.
Sure.
But the tax adjustments and spending components, they provide a strong uplift to the middle-income consumer. So you get this virtuous cycle where profit growth is supported by demand growth.
Now let's talk about the Fed. What's the interest rate forecast baked into all this optimism?
They're forecasting continued Fed easing, specifically 2 25 basis point rate cuts.
Okay, 2 cuts.
And this is maybe the most fascinating piece of the macro puzzle. Historically, the data shows this really powerful, repeatable pattern.
What's that?
PE multiples tend to rise significantly, often spiking between 10 and 15%, when you get the simultaneous combination of non-recessionary rate cuts and accelerating economic growth.
That combination is the sweet spot. Why is that pattern so robust?
Well, because it resolves uncertainty. Rate cuts signal that the Fed is confident the economy is sound, that it no longer needs restrictive policy.
So that lowers the cost of capital?
It lowers the cost of capital for corporations, and crucially, it increases the certainty factor for investors. When investors are more certain about future earnings streams, they're simply willing to pay a higher multiple for those dollars today.
So if the Fed delivers those cuts and growth hits 2.5%, there's a real argument for multiple expansion, meaning the S&P could actually overshoot that 7,600 target.
Absolutely. But in their base case, the forecast is pretty conservative. Earnings growth is doing the heavy lifting.
I see.
The expected 12% EPS growth accounts for the vast majority of that forecasted 12% total return. It's the same dynamic we saw in 2025. Profits, not market euphoria, drove performance.
But if 12% EPS growth is the engine, that sounds, well, priced for perfection.
Yeah.
Which brings us right to the key tension: high valuations and market concentration.
Precisely. This combination represents significant potential energy that could be released as a kinetic downside risk if that earnings story, that 12% target, disappoints even slightly.
So where do valuations actually stand? How do they compare to past peaks?
The S&P 500 is currently trading at a forward PE multiple of 22 times earnings.
22.
That matches the peak multiple we saw during the post-COVID euphoria in 2021 and is just 2 turns shy of the all-time high of 24x from the dot-com bubble.
So it's an elevated starting point, to say the least.
It is. And when the market is this expensive, the range of potential outcomes for the year just widens dramatically.
And this high multiple, coupled with that extreme market concentration, that's what's really fueling the anxiety. The risk isn't just generic. It's idiosyncratic risk tied to just a handful of stocks.
It is extreme. The 10 largest stocks in the S&P 500 now account for 41% of the index's market cap.
41%.
And 32% of its earnings. And to grasp the dependence, just consider that these top 10 names drove 53% of the S&P 500's total return in 2025.
Wow. So if just 2 or 3 of those names stumble, the entire index target is in jeopardy.
The whole thing.
A 22x PE near the 2000 peak, plus that concentration, it naturally makes investors ask, are we in a bubble? What's Goldman's strongest counter-argument to that?
The report is very clear. The key features present in the, say, 1920s, 2000, and 2021 drawdowns are largely absent today.
Such as?
Well, first, speculative activity is still below prior highs. Second, investor flows are actually quite subdued. Last year, U.S. equity funds only got about $100 billion in net inflows.
Which sounds like a lot, but in context.
In context, it's tiny. It's just 0.2% of the S&P 500's total market cap. Investors are still sitting on massive amounts of cash in bond funds and money market assets.
Meaning they haven't capitulated to the euphoria yet.
Not at all. So that sideline cash offers a buffer, a source of potential buying power that just wasn't there at past peaks.
What about corporate financial health? That often collapses when the economy turns.
This is a major differentiator. Corporate balance sheets are rising, yes, but leverage remains low relative to history. The S&P 500 net debt-to-EBITDA ratio currently stands at 1.6 times.
And what does that mean?
Well, that ratio ranks only in the 45th percentile since 1980. So the foundation is structurally sound. It gives corporations flexibility to handle, say, rising input costs or a dip in revenue.
So unlike the over-leveraged environment of the late 90s,
Very different.
that really does make the concentration risk the central tension, forcing us to ask if the largest companies can keep justifying their massive share of returns. And that leads us directly into the required evolution of the AI trade.
Indeed. The market cannot rely solely on the first-order beneficiaries, the direct infrastructure providers, indefinitely. We are now pivoting into a phase where the market requires proof of concept beyond just capital expenditures.
This is the shift where investors stop rewarding companies for, say, building the shovels, and start rewarding the companies that use those shovels to actually dig for gold.
That's a great way to put it. The core pivot is the expected deceleration in the growth rate of AI CapEx, even though the total spending will continue to be staggering and probably exceed consensus.
So the growth rate is slowing.
Yes. The hyperscaler CapEx, which saw that rapid 75% year-over-year growth in 2025, is now projected to see that growth rate moderate.
Let's drill down on those spending figures, though, because they are terrifying. They project hyperscaler CapEx to reach $539 billion in 2026. What does that kind of spending commitment imply about the required revenue and profit realization down the road?
This is probably the most crucial and maybe scariest data point in the entire report. That $539 billion spend is on pace to reach 75% of the collective cash flows of those hyperscalers.
75%.
That magnitude is dangerously similar to the level of spending we saw during the late 1990s TMT frenzy.
75% of cash flow going to CapEx is an enormous bet on the future. What kind of future profit realization is required to justify that spending?
The required profits are immense. To maintain the historical returns on capital investors are used to, those companies would collectively need to realize an annual profit run rate of over $1 trillion.
$1 trillion.
Yes. And That's more than double the current consensus 2026 income estimate of $450 billion.
That is a gigantic gap.
It is, and that gap between projected profit and required profit is the real source of micro-risk for the entire S&P 500, given the concentration we just talked about.
So it means the next phase of the AI trade is less about who supplies the chips and more about whether companies can successfully monetize the infrastructure that's already been built. How must investors shift their focus across the 4 phases of AI adoption?
We are moving past exclusive reliance on phase 2, which was that pure infrastructure build-out. The focus is now shifting to 2 specific areas: phase 4, the productivity beneficiaries, and phase 3, the enabled revenues.
Okay, let's define phase 4 first. Who are these productivity beneficiaries?
These are the companies now quantifying real-world efficiency gains from AI adoption. So, think of companies that historically have high labor cost shares and are highly exposed to AI automation tools.
So like banks.
Exactly. The report specifically screens for sectors like banks and certain IT services firms that can use AI to cut costs dramatically and boost margins.
Yeah.
They're justifying their valuations not through explosive revenue, but through efficiency.
Got it. And what about phase 3, the enabled revenues?
That category focuses on the AI platform stocks and the broader cloud providers who benefit from increased customer adoption of AI services and tools. Yeah. It's less about selling raw compute power and more about selling the services built on top of that power.
Interesting.
They also highlight a fascinating subcategory, phase 3D, which they call AI in the physical world.
AI in the physical world, so robotics and industrial automation.
Precisely. That group experienced notable outperformance in the second half of 2025. It suggests the market is starting to look beyond the server room and into the factory floor and the supply chain for AI winners.
And just to bring us back to valuations one more time, despite the spectacular growth that's needed, the 10 largest stocks today are trading at a PE of what, 27x?
27 times, yes.
Which, while high, is still significantly lower than the 43x peak we saw in 2000.
Right. It reinforces the idea that although the growth expectations are high, they're being tied to concrete existing earnings, not purely speculative future cash flows. It's a market driven by highly concentrated, but actual profitability.
Okay, moving into investment themes. It's clear the market offers ways for active managers to capture both broad beta and targeted alpha. Before diving into the opportunities, how does the report address risk for, say, index investors?
Well, it points out that while the distribution of S&P 500 outcomes is wide, you can manage risk. They note that 12-month implied volatility is low, ranking in the 34th percentile. And importantly, investment grade, or IG, credit spreads are tight.
How tight?
They're in the 8th percentile.
And why does the 8th percentile for credit spreads matter to an equity investor?
Because tight credit spreads signal extremely low perceived risk in the debt markets. This suggests the underlying economy, and specifically corporate credit quality, is not signaling an imminent financial crisis or recession.
It's a structural safety indicator.
It's exactly, giving index investors some confidence to maintain upside exposure while hedging.
All right, let's transition to the 5 core opportunities they identify. Theme 1 is the mid-cycle acceleration. What sectors benefit from that 2.5% GDP growth?
So this theme favors cyclicals, where valuations are still relatively suppressed despite accelerating growth forecasts. They specifically like stocks exposed to the middle-income consumer.
Who benefits from that OBBB package?
Right, and also firms tied to non-residential construction, where forward-looking indicators are signaling an improving environment after a period of underperformance.
Okay, theme 2, the great releveraging. Driven by the debt needed to fund all this growth in CapEx, we're talking about $2.3 trillion in U.S. debt issuance in 2026.
That massive issuance creates direct tailwinds for the lending ecosystem, rating agencies, bond underwriters.
Yeah.
But the major consequence is a premium placed on companies with robust free cash flows that are actively returning cash to shareholders.
Financial discipline is prized.
It is, which is why the buyback aristocrats basket is highlighted.
And theme 3, which we've really explored, is the AI future is now. The shift from phase 2 infrastructure to phase 3 and 4 utilization, all about that micro-rotation.
Exactly. The shift means finding companies that can quantify those efficiency gains and capture new enabled revenues, especially those in the physical world, that phase 3D.
Then there's theme 4, the art of the comeback, focusing on capital markets activity. We're finally seeing some life in M&A and IPOs.
M&A activity surged 75% in 2025, and the overall IPO barometer is signaling a really conducive environment for equity issuance.
And that's crucial for private equity.
It is. The report forecasts that private equity distributions will finally exceed capital calls in 2026 for the first time since 2019. That creates a powerful tailwind for alternative asset managers.
And finally, theme 5, the search for value, which has been quietly gaining traction.
Value is expected to continue outperforming because of these still wide valuation spreads. The report highlights an overweight in healthcare.
Which is fascinating.
It is, because healthcare is usually defensive, but it's trading at a valuation discount relative to its profitability. And it acts as a key hedge against that extreme tech concentration risk.
And beyond healthcare.
They also recommend overweights in materials, consumer discretionary, and software and services, which reflects a mix of cyclical growth and specific areas of AI adoption.
So to wrap this up,
to reiterate the central finding of this incredibly detailed report, the 2026 outlook is fundamentally constructive. That 7,600 target is primarily driven by that powerful 12% expected EPS growth. It's supported by a macro environment of accelerating growth and non-recessionary Fed easing. But the path remains highly sensitive to two non-negotiable factors. The successful realization of AI profits, which, remember, has to basically double the consensus estimate to justify current CapEx, and maintaining that strong growth trajectory without any unexpected tightening from the Fed.
So what does this all mean for you, the investor, navigating this high-stakes landscape? The key takeaway, and maybe the most encouraging aspect for active investors, is a combination of low realized correlation among stocks and that wide valuation dispersion. This provides an unusually solid backdrop for active stock picking and alpha generation this year. In 2026, the overall index momentum will be important, sure, but the path forward will be decided far more by the micro-level decisions. Specifically, how well you identify and invest in that structural shift from AI infrastructure to the Phase 4 productivity beneficiaries and the cyclical rotation into historically discounted sectors like healthcare. The question you really need to be mulling is not if AI changes things, but which specific companies successfully turn that $539 billion in CapEx into a $1 trillion profit realization.
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.